So we go to chapter 13 in economics, A level, monopoly and monopsony. So we're going to start with monopoly. When we talk about monopoly, we're talking about a market structure where you have only one seller of a product or service in that market. So it simply means the market belongs to the firm. So I mean, the industry is controlled by the firm. That is what a monopoly is. So I'm going to read further. They said monopoly and monopsony. There are situations where one firm dominates the market. So a firm dominates the market. Either as a monopsony or as a monopoly, you are a firm because whatever you buy, you are the only one that buys from the supplier or you are the only one that sells to the customer. So that means you dominate the market. Do you get the point here? So we start with monopoly anyway. Monopoly is a market structure where a single seller controls the entire supply of a particular good or service, facing no direct competition. So it's a monopoly because there's no close substitute. You literally have no substitute. So that means you don't have a rival. That makes you a monopoly. I think it's clear. So what are the assumptions of a monopoly? First one, monopolist. They are monopolists because they are the only one, they are the only firm in the market or in the industry. So the firm makes that industry, and that makes it a monopolist. Two, barriers to entry prevents new firms from entering the market. So barriers to entry and exit. So it means because it's a monopoly, no firm, potential firms cannot penetrate into that market. So there's no room for a new competitor or a new rival or substitute to be in that market. That's another point there. And the third one, the monopolist is the short-term profit maximizer. So a monopolist makes short-term profit is a profit short-term profit maximizer. And when we talk about short-term profit maximization, we're talking about a point where it produces the quantity of where MR intersects MC. So why is a monopolist a short-term profit maximizer? Is a short-term profit maximizer because the demand curve that faces the monopolist is downward slope. So it's either you increase your price to reduce your output or to reduce your sales, or you reduce your sales, or you reduce your price to increase your sales. So it's always the downward slope. So that's why it is only in the short run a monopolist can make a profit maximization. So that takes us to pure monopoly. So why do we call it a pure monopoly? We call it a pure monopoly because it exists when a single company is the sole provider of a product or service within the market and there are no close substitutes available. So it's pure monopoly because there's no close substitute available. I think it's clear.
What's a pure monopoly though?
Yeah, it's like a pure monopoly here. We could talk about maybe Gecko, the General Electric Company of Libya. It's a pure monopoly. There's no substitute for Gecko here. So that's an example. I think it's clear. So what are the sources of monopoly power? There's monopoly power because you decide the price. So you have that power. You have that power because you are the price maker. That's what monopoly power is about. There's monopoly power because the monopolist is a price maker. I think the point is clear there. So what are the sources? Monopolists acquire power over their market based on the following reasons. One, barriers to entry and exit. When we talk about barriers to entry and exit, it simply means that monopolists are protected from new entrants. So they are protected from new entrants, maybe because of the sunk cost. And when we talk about sunk cost, we're talking about the cost that you cannot recuperate, the cost that you cannot recover. Do you understand? Cost of facility and all these things. You can't. So they make sure that nobody comes in. Because if anybody comes in, it becomes difficult for them to leave. So there's barrier to entry and exit. Two, legal barriers. So the law, there might be legislation that backs a monopolist, that makes it to become a monopolist. The third one is capital cost. A monopolist operates on a larger scale, yes or no? So for you to want to come into that market, it means you have to be financially capable. And the cost of starting up a business in such situation might be difficult, might be high. So that even discourages you from going to the market. Economies of scale. A monopolist has economies of scale because it operates on a larger scale.
Yeah.
So you wanted to come in to compete, you have to start by ensuring that customers trust you. But you want to say something?
Yeah, because cost is going to be higher once you enter.
Once you enter. So it's difficult for you too. So others might, because the monopolist already has the market power. So you coming in, you're going to incur more cost. You cannot quickly operate on a larger scale. So that could be an hindrance for you to come in. Anti-competitive practices. a monopolist might come up with different anti-competitive practices that would make it difficult for new firms to enter, and marketing barriers like advertisement. A monopolist has the power to spend more on advertisement, and you might not be able to do that. So these are the reasons why we have barriers to entry. Is it clear?
Yeah.
Any question about that? And the next reason, the next sources of monopoly is product differentiation and the number of new or near competitors. Monopoly power exists through a high degree of differentiated products. With high level of product differentiation, it means the level of substitute reduces in the market. So the higher the level of differentiation, the greater the monopoly power. So if there's high degree of lack of substitute, it means there's power for the monopolist. So that is the point there. Any question about sources of monopoly and monopoly? Good. So that takes us to the revenue. The revenue curves. A monopoly firm is itself the industry. I said that earlier. So it means you don't talk about a monopolist because the monopolist is the firm, is the industry. So the monopolist therefore faces a downward sloping demand curve. A monopoly firm can increase the demand for its products in the market only if it reduces its price or increase price by reducing sales. So a monopolist cannot increase price and sales at the same time. It is not possible. So that's why the revenue curve of a monopoly is facing downward. Clear? So the revenue curve of a monopolist, the demand curve shows the quantity bought at any given price. This price is the same as the average revenue. So demand is the same as AR. We talked about that earlier. So if the average revenue is falling, marginal revenue must be falling too. This is because for a firm to increase its sales, the extra unit, it has to reduce its price, as it is impossible to also charge a higher price for other customers. So if a certain customer is buying a product from you and it wants to buy an extra unit, it's going to be able to buy an extra unit all because you have reduced the price. So if you are reducing the price for the extra unit bought, whatever customer, the next customer that wants to buy, before buying the extra unit, you have to reduce the price too. So it simply means as soon as the average revenue falls, the marginal revenue will fall more than the average revenue. Why? Because if you want to buy an extra unit, I have to reduce the price. And for me to buy the last unit before the extra unit, for me to buy, you have to reduce the price. And if I'm going to buy an extra unit also, you have to reduce the price. So the marginal revenue will continue to increase or reduce further than the average revenue if a monopolist really wants to sell more. That is the point there. Is it clear? Is it clear, please? Yeah. Okay. So that takes us to profit maximizing equilibrium output. Are you there? Yeah. For profit maximizing equilibrium output, a monopolist maximizes profit by producing the quantity of output where marginal revenue equals to marginal cost, and then set the price based on the demand curve at that quantity. So the quantity will be QM, where MC intersects with MR, where we have our PM, below the ATCM. So what I'm saying is this: there's profit maximization rule, which says one, when a monopolist, like any other firm, aim to maximize profit, and profit is maximized when additional revenue from selling one more unit MR equals to the additional cost of producing another unit. So there's profit maximization level of output where MR equals to MC. I think the point is clear there.
Yeah.
So what happens afterwards? Excuse me, please. So if the marginal revenue is greater than the marginal cost, the monopolist can increase profit. And how can you increase profit? You can only increase profit where your MR is greater than your MC by producing more. Why will you be able to produce more? You're going to be able to produce more because the extra revenue exceeds the extra cost. Get the point here? As soon as your marginal revenue exceeds your marginal cost, a monopolist will be able to make more profit. And to make more profit, what you have to do is to increase your production output, because your extra revenue is greater than the extra cost. On the other hand, if your marginal revenue is less than your marginal cost, that means you're incurring more cost, extra cost. What can you do as a monopolist? You reduce your output. So when you reduce your output, it allows you produce less. And when you produce less, what happens? Supply within the market reduces. That allows you to increase your price and make more profit. So that's profit maximization rule. MR equals to MC, And if MR equals to MC, it means if MR equals to MC, it means the profit maximizing level of output, that is where you have. But if your MR is greater than MC, it means you have to produce more. And if your MC is greater than MR, or your MR is less than MC, it means you have to produce less. Is it clear?
Yeah.
So the graphical representation is this. So here, the firm, a monopolist, produce here, where we have QM, PM. There's a rise, there's supernormal profit here because this is your average revenue. It's greater than your average cost F.
Yeah.
Is it clear? Any question about that?
No.
Okay. So in the next class, we're going to talk about, I think we're going to talk about the natural monopoly. Sorry, please.